Hello guys, Assalamualaikum warahmatullahi wabarakatuh. In this time, I will explain about the cost of capital. The cost of capital is the 10th chapter of one financial management course. And stay tuned on. Before I explain the material, introduce myself. My name is Firda Indirasari, major in accounting from the Faculty of Economics and Business of the Jember University. So, what is the cost of capital? The cost of capital is the real cost that must be incurred by the company to raise funds from the debt, preferred stock, common stock, as well as earnings withheld to finance and investment or company operation. So, the company's overall cost of capital is the average number of different types of funds that are. And the next is the cost of capital component. There are three components of capital cost. First is the cost of debt, 2. the cost of preferred stock, and 3. the cost of equity. The cost of debt is obtained by issuing bonds or borrow money from a financial institution like a bank. The second is the cost of preferred stock. Preferred stock is a stock that the owner will have the right more than the right of the owners of the common stock. Preferred stock will get dividends first and also have more voting rights than ordinary shareholder as voting in the election of the board of directors. So that the ranks of management will resorting mildly to pay payment accuracy preferred dividend so as not a step down. The third is the ordinary equity. Ordinary equity provided by the holder of the common shares of the company and are grouped into ways, namely publishing of new common stock and holding the spider of the rated ending current year. The first is the cost of debt. The cost of debt can be defined as the part that must be accepted from an investment, so that the minimum level of the result of the creditors are met. If companies use the bonds as a means to obtain funds from long-term debt, then the debt is equal to the cost of KD or yield to maturity, namely the level of benefit enjoyed by the holder or purchase of bonds. The cost of debt can be searched by the interest rate is reduced by the tax saver. The second is the cost of preferred stock. To calculate this, the preferred dividend must be divided by the current price of preferred stock. Next is the cost of equity. Ordinary equity compiled into ways, namely publishing of new common stock and holding earning rated current year. From the way, the second issuance of new common stock has higher cost because there is an additional cost of emission that must be paid to the investment banker who helped the company issuing new common stock. To calculate the current year profit of the tension, there is three ways. First is capital asset pricing model, and 2. discounted cash flow, and 3. discount cash flow approach. Capital asset pricing model is a method of calculation of the valuation of capital asset by way of risk-free rate plus a risk premium multiplied by the market beta. The second approach is the discounted cash flow. The discounted cash flow calculated by way of dividend pursued by the current share price coupled with the expected growth rates. And the next method is approach the yield of bond plus a risk premium. Buy common stock are generally more risk than buying bonds that provide a fixed income and relative certainty. Therefore, investors will buy shares expecting a normal risk premium level profit above bonds. The magnitude of risk premium depends on the company's condition and the condition of the economy. Bond approach yield per risk premium is another method that can be used to determine the value of asset, particularly equity, public company. Bond approach yield plus risk premium allow use to estimate the rate of return demand on equity with equity risk premium for adding yield to maturity on long-term corporate debt. After all the cost of each component above is calculated, then the next is to calculate the weighted average cost of capital. The weighted average cost of capital calculated by multiplying the proportion of which multiplied by the cost of debt plus the proportion of preferred stock is multiplied with the cost of preferred stock plus proportion of equity multiplied by the cost of ordinary equity. The next is a factor that can affect the calculation of the cost of capital. There are two factors, namely the factors that can be controlled and factors cannot be controlled. Factors that cannot be controlled by the company, they are the level of interest rate and tax rate. The first is interest rate. If interest rate in the economy increase, then the debt cost will also increase because the company had to buy holders of bond with the higher interest rate to obtain debt capital. The second is the tax rate. Tax rate used in the calculation of the cost of debt used in the weighted average cost of capital. And there are other way less tangible tax policies which affect the cost of capital. Next is factor that can be controlled by the company. There are three factors that can be controlled by the company. The first is the policy structure of capital. Weighted average cost of capital calculation based on the interest rate of each component of the capital structure composition of capital. Capital structure so that if the transformed, then it costs capital change. The second is the dividend policy. The decline in dividend payout ratio might be caused in own cost of capital is rising, so the weighted average cost of capital will go up. And the last one is the investment policy. The investment policy is own investment policy will take effect at risk. Big nothings of risk is what will affect the cost of capital. Another problem in the estimation of cost of capital are 5. The first one generated by shrinkage. One of the big sources of capital for many companies is shrinking, but we do not discuss the cost of funding from some. In short, cash flow depreciation can be reinvested or returned to investor. Next is private company. As long as this, we know that the cost of equity itself is only centered on a public company. Then the question will be how to measure the cost of equity from a private company, whose shares are not traded, especially the issue of taxation. But in the facts, the calculation of land is the same, that is in accordance with the general rules and principles that already apply, but it may be different on how to obtain input data between the two. Next up is the problem of measurement. When we estimated the cost of equity, then to get a G or estimation or expected growth in the calculation of capital asset pricing model is extremely difficult because the value of the G or the growth rate cannot be estimated as accurately as. Next is the calculation of capital cost on the project with a different level of risk is also very difficult because there is a difference in level of risk, and the last is weighting structure of capital. In this chapter, capital structure weighting myself have set goals so that we stay put in the formula, but in the fact to determine target capital structure itself a great job and is very hard.